This is the CRA Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRA process with comprehensive tools and data. I'm Thomas Oblaco, the guest moderator, and on my last day on my summer internship. I'm with co-hosts Dianne, Crocker, and Manus, Clancy. Welcome to this week's episode. Let's dive into the news development week. Manus, what's on your mind?
We had a lot going on this week. There was a lot of data to process, a lot of earnings to look at. We had a Fed announcement this week. And a lot to peel back, Dianne. This opening may go longer than usual. Let's start with Fed Wednesday. The Fed held rates steady midweek, although not without some debate. 3 of the 12 Fed members dissented this month, indicating that they would rather have had a rate hike than leaving rates steady, which is what the other 9 members voted for this month. Dianne, what's your take on that? Were you surprised by the move, or was that expected for you?
I wasn't surprised. What really struck me is that the dissent itself, I think, was the headline. So Chair Kevin Warshke leaned into the dissent, it seemed, in the coverage that I saw. And he even called it, from one news source, he called it a healthy family fight rather than a dysfunction. So it kind of brought to mind like Thanksgiving family squabbles, over politics. But I mean, joking aside, like it's an unusually strong dissent, I think, that really shows that worries about sticky inflation and the likelihood that inflation will go up even higher the longer that the war drags on are starting to intensify within the Fed. And one thing I was thinking about this morning as we prepared for today's podcast is think about the shift. Until mid-year, all of the conversations were about when the Fed might cut, just like they did in 2024 and 2025. And now, in the matter of just a few months, the conversation is increasingly about whether the Fed will have to hike. And in the wake of yesterday's decision to stand firm, futures markets moved to price now a better than even chance that rates will go up at the next meeting in September by 25 basis points. So it was an interesting day, not a surprise, but it kind of raises a lot of questions about whether we will in fact see a hike this year.
Our listeners know this, Dianne, you know this. Personally, I don't believe this is time for the old playbook. Rate hikes are a tool the Fed can use to slow an overheating economy. It is to be pulled out when prices are soaring because the U.S. economy is surging, that we are in hypergrowth. What we've already had is its own form of rate hike by virtue of $100 oil or $120 oil. This is the time to throw out the traditional playbook. You have to think outside the box. In my opinion, the higher oil prices have already provided the brakes to slow down the U.S. economy. We saw the number this morning, GDP coming in lower than expectations, something you pointed out to me before we started recording. And to me, that's the sign that there is no need to hike rates at the moment. I think the people are working off of their 1995, 1997 playbook, and it's not appropriate right now.
Well, Manus, I certainly hope that the Fed is listening to this podcast. Even without a hike this week, or a cut, honestly, markets, they're tightening through higher Treasury yields, which are up at record highs now, wider risk premiums. So the Fed can hold rates steady, but the 10-year, for the longer that it remains up there at record highs, it means higher borrowing costs. It affects refi proceeds. It keeps property values under pressure. So I guess my question for you, Manus, is oil prices seem certain to keep inflation high, which, as you pointed out, is a penalty on the market, and it makes a hike seem more and more probable. So what do you do as a borrower? Do you retreat, or do you try to lock in capital now before rates go even higher?
I'm not terribly concerned about rates going higher absent a mistake by the Fed. I think they were at 468 this morning for the 10-year, which you pointed out is around the highest level we've seen in 2026. And that's a bit discouraging. But I'm not in that camp of people that sees this going from 468 to 5 or 5.25. I do think that this jolt we're getting, and we get it every 2 or 3 weeks, when it moves from the combatants talking about peace to escalation in the fighting and new bombings every single day. So oil kind of is floating up and down with that. But this is not a permanent state, in my opinion. I think that this is something that retreats over time. And when it retreats, we will see lower rates. I think people are discouraged that we're almost in August and something that started in late February is still happening. So I suppose it makes sense that people think we might be faced with $100 oil for the next 2 or 3 months or the next 6 months, and that the inflation readings will remain high, and accordingly, bond yields will remain high. But I'm not one that thinks that oil is going to $200 a barrel. I don't think that the shock is going to be such that we're at a 525 or 550. I suppose to answer your question, I would be patient here. I'm not dying to lock in capital when the 10-year is near 470, but then again, I'm bullish, and you know that. I've been bullish for several months now that this is temporary, and I think over time, this will fade.
Yeah, I hope you're right. And I guess one thing that the market maybe learned and we learned is how quickly the market does bounce back. Just on the expectation that a peace deal was near in June, which obviously didn't materialize, we saw the market start to improve just based on the hope that that would happen. So you have to think that when a peace deal is reached and the conflict ends, that the market will recalibrate fairly quickly and get back on track.
My biggest fear is that both sides are so dug in that it's going to take another round of increased hostilities before we get to resolution, which would be sad to see. It doesn't seem like a resolution is imminent, and that's very, very discouraging. And it does seem like this week, the last 2 weeks, that we've seen the fighting kind of expand. Saudi Arabia is now involved. The Iranian proxies are now getting more active in trying to fight in the straits. It's very discouraging, and the sooner this ends, the better. I hope that there is an off-ramp somehow for all of us. Before we go any further, I want to talk about something. It kind of ties into the rate hike discussion we were talking about a moment ago. One of the few things that made me think that a rate hike could be plausible was 2 months ago, stocks were so on fire and there was so much speculative buying of chip stocks, Micron, AMD, SanDisk, Western Digital, things like that. Stocks were up hundreds of percentages over the last year that I thought that would be the one reason you might want to take the punch bowl away. You might want to hike rates. But now that reason is off the table too. We've seen shares of those high flyers fall up to 30% over the last 2 months. So we're not talking about the same euphoric market we were talking about in late June. And again, that tells me the market is disciplining itself.
Manus, I nominate you to be on the Fed for the next round, but I hear what you're saying. I think back to like my economics 101 classes. If the GDP report came in stronger, if the equities market was starting to show signs of weakening, then I think yes, it would have validated the kind of hawkish case for a hike, right? Instead we had weaker than expected GDP growth for Q2. We have core PCE that's still elevated and likely to come in even higher in July. So I think you're right. The market is kind of self-regulating, and hopefully the Fed doesn't make a misstep at the September meeting.
And of course, the Fed only controls short-term rates. They don't control the long end of the curve. The fact that the 10-year is at 470 or close to that this morning tells you that the market is disciplining itself. It doesn't need the Fed to whip out the ruler and snap investors' knuckles at the moment. That's just not necessary. I do want to take us down one more rabbit hole before we move on, and that has to do with earnings. We saw some big numbers yesterday. It's a big week for tech earnings. A lot of the Mag 7 are reporting this week, and we saw two big earnings in the last 24 hours that went in different directions. And it's funny, this morning I was talking to podcast guest Joe McBride, who's at Citus right now, and we were talking about a variety of issues over the last couple of days, and one of the topics was AI. And we both joked that we are on kind of a roller coaster with AI, that there are some days that we think it's going to be life-changing in the sense that earnings for companies will be through the roof, we'll get incredible productivity gains, that the stratosphere is the limit for us. And then there are other days where you just think this is years off, we're still getting nonsense out of people's MCPs, we're getting travel guides and not real data. So we go back and forth. But I thought this week's earnings data was quite informative. On the one hand, you saw Microsoft, who talked about great demand for their cloud services through Azure. They beat revenue expectations, and their stock is up big time today. They were a winner. On the other hand, you saw Meta, which said, no end to our capital spending. Our revenue was light, and we have eaten through all of our free cash flow. And basically, our free cash flow over the last quarter was flat, zero, nothing. So it's a very open-ended question, but I wanted to find out if you were on this roller coaster and what thoughts you took away from those earnings today.
Yeah, well, Manus, you just mentioned kind of the two bookends. You have Meta at one end with higher AI capital spending in their outlook, and the hope that will translate into returns in the end. But investors need clearer evidence of that for sure. So Meta's on the hot seat. And then you mentioned Microsoft. My view on that is they came in with a counterpoint because what do their numbers shows? Heavy investment. It shows visible positive results. That's exactly what investors want to see. And I feel like with all the questions coming up about AI investment and whether they will materialize into ROI down the line is forcing investors to kind of separate the companies that can convert these $1 billion of capital expenditures into revenue and cash flow. And, some companies are asking their investors to have patience, but I think in some cases that patience is starting to wane a bit.
This was a very clarifying moment, these two earnings. And it may end up kind of informing my own personal investment thesis, going forward. And that is a firm like Meta, you're really taking a flyer on AI. You're saying, we believe that this company that was really good at creating a social media company is going to be able to create a model that people need and people want that will be as successful as what they've done in Facebook. Because they're not like Google, they're not like Microsoft. They don't have cloud computing services that can kind of hedge, if you will, kind of the positive of AI versus the negative. When you look at Google, they might fall into that same category. They created the best search engine. Does that mean they're going to create the winning AI model that people will just mint money off of? That's no sure thing. And they're spending money hand over fist and eliminating all free cash flow. When you look at the others, when you look at an Amazon or a Microsoft, and I never really thought about this until these earnings came out, they're the perfect hedge. They have this cloud computing that everybody needs, which even if they don't make the greatest model out there that doesn't become the dominant force in artificial intelligence, they still will benefit from the fact that everybody needs their servers, their cloud compute, and everything that goes with it. And I think this might be a real inflection point for the market.
So sell Meta, buy Microsoft. Is that the advice you're giving people?
Well, certainly that would have been a winning trade. Meta down 10% today and Microsoft up 10%. I wish I had thought of this a couple of days ago, but we are a commercial real estate podcast. And I do think that it translates into who's going to need more space and who's not, right? For 10 years between 2014 and 2024, these firms universally were gobbling up space hand over fist across the U.S., in Seattle, in Austin, in the Carolinas, Virginia, and so forth, adding people, adding second hubs, and so forth. And then we got to 25 and 26, or I should say 24, 25, and they started to scale back. They didn't need all that space. And you may see the same thing, that firms like Microsoft and Amazon continue to be big takers of space because their AI is winning, and less so for the Facebooks of the world, the Googles, and so forth.
Yeah. I mean, historically, these are massive shifts in how space is being used. So you have to wonder, 10 years down the road, 20 years, is this viewed kind of in the broader context of demand for commercial real estate?
We did have one more data point. I'll let you comment in on this. We did see PCE come in here, the Fed's preferred measure of inflation, the personal consumption index. What do we get today?
Yeah, so it came in close to expected, still hot. Core PCE landed at 3.3% year over year, kind of on the softer edge of the expected range. It was down slightly from May's 3-year high of 3.4%. But remember, energy prices came down about 6% in June as the Middle East tensions eased, and gasoline came down 9.2%, but now we're paying at the pump again. So I think, certainly a month down the road when July's PCE comes out, it's going to be higher because gas prices pushed it back up again.
And next week we have the jobs report. That'll be very interesting to see. We went through a very cool period for about a year. The last couple of months have been better, but not great. I think people will be interested to see how this is holding up in the face of all these AI layoffs. On the one hand, where there's repetitive tasks that AI can do versus the hiring that's going on at the high level of data scientists and engineers and so forth.
Very true. Lots to talk about, lots of moving pieces and lots of implications, obviously.
That seems like a good place to switch gears. Dianne, what do you have for us for this week's Data Dive?
Last week, Manus, you talked about how Lightbox digitized city directories dating back to the 1800s. It was a mammoth project. It makes it easier to unlock data records on a property's past, whether there was an underground storage tank, a gas station, a long forgotten tenant in today's strip mall. But another important part of our historical property records are aerial photos. They can show you things like a warehouse that's sitting on what used to be a landfill 50 years ago, or that an apartment building replaced an old service station. So for this week's data dive, I want to focus on something that my colleague Kathleen Lavalley recently highlighted on LinkedIn. In 2025, we acquired and georeferenced 103,802 aerial images for Lightbox Live. And so far this year, that number has already reached nearly 200,000 more images. But one image that Kathleen shared on LinkedIn caught my attention because I'm a movie buff. And it's an aerial photo from 1939 of Atlanta's airport. And in it, you can see an old runway with a tiny terminal. And if you look really closely, you can clearly see the words, "Atlanta welcomes Gone with the Wind," painted on the runway to mark the film's premiere. So here I am today. I'm holding tickets for the Odyssey to see it next week. And it's the first feature that's filmed entirely with IMAX cameras. But in 1939, the blockbuster event was Rhett Butler and Scarlett O'Hara, and it became the first film in Technicolor to win Best Picture. So historical aerials capture fun moments like that, but they also help us understand what happened on a property decades before today's buildings ever existed.
That is really cool. When I think about air travel from 1939, this image just came through my head where there's a sign on the runway which says, come fly Eastern Airlines or Pan Am, now with enclosed cabins, right? You're not using the leather helmet anymore with the flaps over your ears like fighter pilots did in 1914. So I'm sure that image is quite vivid.
Really funny to think about how far we've come, right?
Absolutely. Must have been really quite something back in the day. And I'm sure there's some survivors now that could talk about that time. Probably not a ton of them, but talk about what Atlanta was like back then versus today, which is the growth that we've seen in Atlanta over the last 40 years is like nothing else.
Yep, for sure.
And what about this week's Did You Know?
So for this week's Did You Know, Thomas, I've been digging into a new tool that's built around Lightbox's transaction tracker. It comes from your group, Manus, and it is a great source of deals that are closing over different time frames, and I can sort them any way I want through filters and generating totals in different ways. So I love it, and kudos to your team for that. But what I did for today's Did You Know is I looked at transaction activity. Everybody's asking, is transaction activity holding up given the war and all the things that we just talked about? And I'll say at a high level, the answer is yes. In June, we logged 1,676 transactions. That was up 40% from May's almost 1,200 and 30% from April's 1,200. For the full quarter, Q2 reached 4,151 deals, and that was up 10% from Q1, and it was up 37% from a year earlier. So I'd say the market doesn't seem to just be muddling through. We're seeing volume growth in the double digits. So shameless plug for our mid-year transaction tracker report, which will have data points like this. So look for more details on that coming out in the next week or so.
It really has been the story, in my opinion, of 2026 as it pertains to CRE, that as was the case in 2025, volatility in the markets, interest rates moving higher. In 2025, it was tariffs. In 2026, it was oil. The market continuing to stiff arm these oscillations in the broader markets, and it continues to soldier on. I know we're going to talk about a couple of big names in the private equity world in a moment. So it isn't all, what is it, roses and unicorn, peaches and cream? I don't know. What is the expression that people use for happy thoughts?
I think it's wine and roses.
Wine and roses. There we go.
Mm-hmm.
The days of wine and roses. Wasn't that Walter Matthau, maybe? That old movie? Jack Klugman? No, somebody else. It'll come to me. In any event, on the sales front, we've continued to soldier on, but there's still something we don't talk about nearly enough. An awful lot of distress out there still being worked through from that 2022, 2023 euphoria. We're now 3 to 4 years beyond when those loans were made, but we're still seeing some negative headlines about firms that have had to face this. And we're really talking about two big problems. Problem number one is offices, where nobody could have expected the work from home, COVID problems. We've seen the obsolescence of big or small offices in U.S. cities. In most of these cities, unless it's really class A plus inventory, you're really talking about declines in asset prices of 50, 60, 70%. So that's one area of distress that still is being muddled through. The other, and this primarily sits with multifamily, but not solely with multifamily, buyers that bought at the peak of the market in 2022 that believed that rents were going to continue to surge as they had in 2021 for 5 or 10 years, that there would be no more building that would impact inventory, and most of all, that used floating rate debt to finance their acquisitions. A lot of these stories ended up with borrowers losing their shirts. We talked about a syndicator last week that was returning $0 to their limited partners. Most of the loans being made to these players that use floating rate debt were not banks. They were often non-bank suppliers, private equity firms, and so forth. And we saw two stories this week that kind of tie into this narrative. One operator looking to take advantage of this, looking to deploy capital to help troubled borrowers muddle through, take advantage of the fact that they have capital, can deploy it, and be opportunistic in the distressed area. And another which is thinking differently when it comes to how to deal with what has been a rocky couple of years. Let me turn it over to you with that, Dianne.
Yeah, it's true. Well, first of all, you were thinking of that old movie, Days of Wine and Roses. It was 1962, so that predates me, but it was starring Jack Lemmon and Lee Remick.
Jack Lemmon, I knew I had the right first name. I didn't get the whole thing. I was mixing the Days of Wine and Roses and The Odd Couple and the movie and the TV show. Yeah, I have to bone up on my, 1960s pop culture trivia.
Well, thanks to AI for that one, because that's not my forte. But back to your question, a key theme of the past few years really is, the broader distress wave that everybody feared in 2023 and 2024 never fully hit, and instead we saw these individual lenders that were kind of quietly restructuring behind the scenes. But you referenced two stories that happened this week. And one is from Fortress announcing that they're scaling up their credit and distressed debt capabilities. They want to capitalize on an estimated 4 to 4.5 trillion in commercial real estate and corporate debt maturities. So they're definitely looking to lean in and join other distressed debt investors that firms like Apollo, firms like Oaktree, firms like Blackstone, who are all positioning for a wave of loan sales and foreclosures. And I think where the expectation is the highest is certainly going to be in the office sector, where CMBS delinquencies are around 11 to 12%, and there are about 76 billion in CMBS hard maturities happening this year. And then on the flip side, Manus, we had another headline about KKR Real Estate Finance Trust, a lender reporting a $121.8 million loss on its $4.5 billion loan portfolio in the second quarter, during which it also repurchased 5.7 million shares for a combined $38 million. So one thing that jumped out at me with that story is that office is the pain point. 2 of the 6 watch listed loans are office, and another one is life sciences. So it's kind of interesting. Banks are re-engaging in commercial real estate lending, but now you've got this private credit adjacent lender who's pulling back.
It's an interesting time. One person's pain is another person's opportunity. And what we're seeing here is one looking to jump in and provide capital to support the distressed market, another considering strategic options, which is the term that was used by Matt Wasilewski of BizNow, who reported on those earnings. And the thing that surprises me about this, I'm interested in your take here, Dianne, is how long this has taken to get to this point. That run-up in rates was in 2023. We were talking about this 4.5 years ago of borrowers not capping their interest costs, NOI going from positive to negative, free cash flow being wiped out, rent growth being anemic, not buoyant as people had been expecting. And I'm surprised that there's still so much out there that has yet to be resolved. When you consider that, I mean, yes, in the great financial crisis, that happened in 2008, and we were still resolving things 10 years later. Yes, we could talk about that, the long tail. But it did seem like big chunks of recapitalization took place by 2012, that we were kind of coming out of that cycle by then. And here it seems like we're still really not that far along.
And now it's definitely got to be a frustrating process for those with capital ready to jump in, because all of the hyperbolic forecasts for distress never materialized. And I think a lot of it that makes this cycle unique is just the uncertainty around rates and where they will land, and all the things we talked about before, where everyone thought rate cuts this year would be a foregone conclusion. And now we're spending time on this podcast talking about the possibility that they might go up even higher. And what does that mean for these maturing loans? It certainly won't be good news on that front. So it's crazy times for the market for sure.
Okay, Dianne, let's switch gears and switch to development. What do you have for us?
Thanks, Thomas. Well, Manus, I love a good redevelopment story. And this one came from Peter Grant at the Wall Street Journal. A developer named 5 Point is breaking ground in September on the first phase of Candlestick. It is a 270-acre master planned community. It's going on the old Candlestick Park baseball stadium in San Francisco. And they're envisioning 7,200 homes, plus offices, plus shops, plus parks. I don't know about you, Manus, but Candlestick Park is infamous for being the worst stadium in the Major League Baseball league. And the reason is because the Bay's cool Pacific air got funneled straight through this gap in the coastal hills and turned into a wind tunnel. So brutal that fans had to wear parkas to games, even in the middle of the summer. And the developer blames that on the way that the stadium was built. But there's a meteorologist quoted in Peter Grant's story who isn't buying it. And he says, no matter what, that site is going to be cold and blustery, regardless of what they build there. So this is definitely a long bet on San Francisco's market. But the angle in terms of that wind tunnel is also interesting.
I got to go to Candlestick Park in the 90s. I am a baseball stadium collector. I love seeing stadiums in every city I go to. I've probably got up to maybe 25 at this point, give or take. I got Candlestick at a good day. It was an afternoon. It was sunny. It was during the Will Clark and Matt Williams days. And so for me, it was a very pleasant day. But there used to be an expression out in the Bay Area that the coldest winter I ever sat through was a summer at Candlestick Park, because the weather was so nasty and cold, as you said, people bringing parkas to games. My takeaway for this story is, like so many of these, that I'm always rooting for guys that are putting shovels in the ground. We need more housing. I love a leap of faith. This is a leap of faith which is not in San Francisco proper. This is kind of outside of San Francisco. You're going to have to sell this area. People are going to have to want to be there. But a developer is taking that leap of faith, looking to build I think you said 7,000 units there. Good on them. They are, or he is, I guess, somebody that I will be rooting for this to be a wild success. And I hope that it comes with great views and a gentle wind coming through what used to be a real wind tunnel back in the day.
I love that. When I saw that headline, I knew that you would have a story about Candlestick Park, but what's interesting to me is that alone isn't the only thing that makes it challenging. Phase 1 of this project means that they have to spend $130 million or more just on roads and utilities before a single home gets built or sold. So when I say this is a long-term bet, it's a very long-term bet.
That makes it even more of a leap of faith and even more worth rooting for, that there's real execution risk here. And yet the developer is willing to take on that risk. I'll leave you with one last fond memory of Candlestick Park. Maybe you remember the movie Happiness, a terrific movie with Will Smith. And there's a scene where he goes out to Candlestick to try to woo some investors, even though he's a mere unpaid intern, if I remember correctly, at some place like E.F. Hutton in the Bay Area, living in a homeless shelter. He finds his way into Candlestick Park to talk San Francisco 49ers fans, the Niners also played in Candlestick, into trusting him with their investments. One of my favorite favorite movies of that era. Happiness with Will Smith, for those that may not have seen it. I'm going to give one more happy story here in the development side, Dianne. Boston Properties, now known as BXP, they have secured a $1.2 billion construction loan for a new 46-story tower in Midtown Manhattan. This will be at 343 Madison Avenue. They lined up a floating rate note, 4-year term, plus a couple of extension options. Reporting there from Maria Minuto of Commercial Property Executive. So another case of a developer taking the leap, taking something with execution risk and putting a shovel in the ground, and good on them.
Yeah, and that's construction debt, $1.2 billion in construction debt at a strikingly low 2.5% initial rate. We've talked about a number of stories like this about office developments near Penn Station, this one's near Grand Central, and it's just another sign that lenders aren't avoiding office, they're just avoiding the wrong kind of office.
Right. Old office, class B or C, amenity free, that is the place where you're buying things for pennies on the dollar. The new stuff with the drip coffee bar, the rooftop hangout area, maybe the sleeping pods, that's what's really winning the day these days.
Okay, let's close with multifamily. What do you have for us, Manus?
Well, Dianne mentioned a moment ago that we've seen sales continue across the U.S. in high numbers. Not only are the numbers high in terms of the count, how many things we're seeing sell month over month, they're also high in the dollar price being paid. And we saw 9-digit sales in the multifamily segment this week, and I'll run through 3 of them in short order. First story coming from Sarah Dolgen of the Washington Business Journal. FPA is paying $250 million for the Riverside Apartments. That's a 1,200-unit complex in Alexandria, Virginia. The seller here is Elm Communities. They have been trying to liquidate all of their holdings for several months now. You've probably seen or you've heard us talk about other Elm Community sales over the last couple months. Here's another one. FPA writing the check here. The interesting thing here is that this sale comes after a previous deal or handshake on selling this property fell through. This was supposed to sell for $280 million. That deal was terminated. FPA jumped in, paying $250 million, a little over $200,000 per unit for this really mega complex in Alexandria, over 1,200 units. A second one in Linwood, Washington, Pacific Urban Investors paying $112 million, almost $300,000 per unit for the Acapella Apartments. That is a 370-unit property, as I said, in Linwood, Washington. The seller there, Widener Apartments, reporting here from Louisa McClouse. And lastly, again in the Puget Sound area, a Mercer Island apartment building trading for $157 million. Reporting here from Rick Morgan of the Puget Sound Business Journal. UDR has sold the Island Square Apartments on Mercer Island for $157 million. This is a 235-unit building. The buyer there, Mesero, which is headquartered in Chicago. And so there you have it. 3 really nice sales, some in the Pacific Northwest, another in the Mid-Atlantic, all with 9 figures.
That's pretty incredible. I did, right before we went live, I saw a post on LinkedIn by a guy he's great to follow. His name is John Chang, and he's at Marcus and Millichap. And he posted something, Manus, that goes right along the lines of what you just reported, which is Q2 data for apartment demand outperformed expectations. And he pointed to renewed job growth overall. He pointed to household formation. He pointed to the high cost of home ownership, all the things that we talked about, but a lot of uncertainty or a lot of differentiation from metro to metro. But overall, Q2 was definitely in demand, way above Q1. And one of the graphs he shared were the top markets for yearly rent growth. And San Francisco was right at the top of the list with 11.7% growth. So that might bode well for the Candlestick Park development that we just talked about.
Well, it's interesting that you bring up San Francisco because I didn't report on one last 9-digit sale. I'll throw it in there just to put a bow around this. This reporting comes from Hannah Kanek of the San Francisco Business Times. Bell Partners bought an apartment complex in South San Francisco at 401 Cypress Avenue for $130 million. So another 9-digit sale in a different city to go along with the first 3 we talked about.
Let's move to the slice of life. Start with you, Dianne. What's your biggest pet peeve?
I think work-wise, I have to say that my biggest pet peeve or annoyance is, and our IT people will hate this if they listen, but those authentication loops that we have to jump through to access data. I'm like increasingly in this situation of like scrambling for my phone to like click to show that I'm legit, then back to my laptop, back to my phone to get a code that I have to enter into my laptop. And I feel like by the time I jump through all these hoops, I forget what I'm doing and what I was trying to do in the first place.
I have to agree with that one, Diane. I wish I had thought of that. The authentication over and over and over again, especially when your phone is charging 30 feet away from you. And
Yeah.
you know the clock is running, that email only lasts for so long. That could be very stressful. For me, I'll go with 2, I guess. On a personal level, I have to say I don't like peas. Somebody serves me peas at dinner.
I agree.
I don't like peas. I haven't liked them since I was a kid. I think they're vile. I can't believe that they weren't put in the category of deadly when people started growing fruits and vegetables back in the early days after the Ice Age. And that would be my personal pet peeve. Do not serve me peas. On a, I guess, somewhat professional level, it is riding on a commuter train in a quiet car when people choose to talk. That is a real irritant for me. And I always thought that Apple should have this device where if 3 people on a commuter train collectively had the same irritation, they could join forces and turn somebody's phone off anonymously. And they couldn't be next to each other. So 3 people couldn't punk somebody else. Like 3 young kids coming home from high school on the Metro North couldn't punk some guy. But if you had 3 people sitting more than 10 feet apart from each other, they could turn off somebody's phone without being doxxed. How about that?
I love
How about
that.
you, Thomas? You must have a pet peeve.
God, it's hard to follow up this. I saw some good innovation there with the Apple device. I would say a pet peeve of mine, this is kind of work and personal related, just bad texters. Maybe I'll text something, I'll be like I'll be asking multiple things and someone only answers 1 to 2 things that they just want to answer, or like they won't respond at all. And I talk to them in person and, oh yeah, I saw that. I'm like, just then respond to the text. So that's probably that, and people being late. I can't stand that as well.
Thomas and I live on 2 different planets. He is critical of what's in the text. I don't want to get a text at all. I don't want to be reached. I want to be left alone.
I love that.
Because it's the difference in the generations.
Listen, Thomas, I want to go on record as saying it was really a delight having you here this summer. We threw a lot at you and you always rose to the challenge. Moderating this podcast is not easy, and you did it not once, but twice. And kudos to you and best of luck to you. We really loved having you here.
Yes, thank you so much. That's very kind words. I really enjoyed this internship overall, and also helping out on this podcast. So maybe in the future I'll be back on. That seems like a good place to wrap up. Thank you to our producers at Brooding Media. Be sure to join us next week as we drill down the news headlines, deals, and developments of the week. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening. Have a great weekend.
Let's go.